If you're done with debt, over living paycheck to paycheck, and ready to actually build some wealth, you're probably thinking about investing in the stock market. But what is the stock market, and should you invest in it? Hi, I'm Sophia. I'm a financial marketer, and in this video, I'm going to teach you just that. I've been working in financial marketing for over a decade. I've been trained to understand how companies make money and how they package information. Sometimes it could be quite hard to understand if a stock is actually going to make you money, if it's a good investment for you and your point of life. And so that's what we're going to go over today. I make videos at the intersection of finance and psychology and family because those are the things that have been like the biggest learnings in my life, and it's where I can pass the most value onto you. If that's something you're interested in, do consider subscribing below. Before we get started, I do encourage you to do extensive research into the stock market and understand what you're buying and why you're buying it and how you think it's going to make you money. Understanding this, as well as creating a diverse portfolio, a portfolio that is consisted of many different stocks and funds, is key to actually making wealth. I've linked some good resources below, so check them out after watching this video, of course. Now let's dive a little bit deeper into what the stock market actually is. There's a market for everything. Just like you can buy and sell food at a farmer's market, exchange cars at a dealership, or buy and sell couches on Marketplace. A market is where you can exchange goods for money or sell goods and get money in return. The stock market is much the same. Companies list so that people can buy a small portion of their company. In return, the company gets funds that they can use to grow. If you buy a share in the company, you're a partial owner of that company, a stakeholder. If that company grows in value, so does the share that you own. If that company loses value, then so does the share that you own. This is the main way people make and lose money in the stock market, though it is one of many and a kind of an oversimplified version of what actually happens. That brings us to our second point, which is how share prices change. I'm going to break this down into two sub-points: things that the company has control over and things that they don't have control over. There are three major influences that a company has over their share price: the things they produce and how they produce them, the relationships and contracts they build, and their reputation. The product a company produces is often the bedrock of their value. If a company releases a new product or produces more of the product that they already have, or they somehow change the product that they have and work on it to make it better, this will probably influence the company's value, which can change the share price. If Apple announces that they've built a new product, this will probably increase the company's value because that's the whole entire other income stream that they can collect from their consumers, the people who buy their products. Relationships are another key way that companies can influence their value. Relationships can lead to work contracts, which can lead to selling more product or selling product to a different market or selling product in a different way. How companies relate to other companies and the landscape at a whole is going to influence how much they can sell, which is going to influence how much they can make, and that's going to influence the stock price. One of the reasons why it's important to understand who's on the team and how they operate within a company is that will impact how they make relationships, how many contracts are formed, and if they're actually able to carry out the work that they've promised to do. When we're looking at a company to see if it has value, understanding who's working for the company, their previous skills, and if you think they're capable of doing what they say they're going to do, that'll help you understand if the company is valuable or not. If a company signs a contract to open 7 new stores this year, this could be an asset and a liability because they have 7 new stores, 7 new markets they could open to, 7 new types of customer bases that they can sell product to, and they know that those customer bases actually want their product. They also have the overhead, the utilities, the rent, the contracts that they've signed to have the buildings that the stores are actually going to live in. That could last for like 5-10 years. So the value that they're going to have for expanding into these new markets has to offset the cost of what they've committed to open the stores. A savvy investor is going to understand what a company is doing when they commit to opening new stores or signing any contract, and if the value is going to be enough to offset the costs. Let me explain reputation plainly. When Samsung's phones started occasionally blowing up or causing a fire and were banned from aeroplanes, this savaged Samsung's reputation. It was because they couldn't deliver on the promise of providing a phone that was safe and that people could take anywhere with them. You weren't sure when you were buying a Samsung device if it would have the same problems that the phones that were blowing up and causing fires had. Reputation is something that a company builds over a long time by fulfilling the promises that they have decided to take and showing investors and consumers that they can actually do what they say they're going to do. Any stock website, Stockwatch, TradingView, Yahoo, is going to list the company's chart, and below that you'll be able to see all the news of the company. A savvy investor reads the press releases that a company has put out, and these tell the story of the company over time. Have they been able to actually sign a contract that they've said they're going to put out? Have they been able to produce as many units as they say they're going to produce? Have they been able to increasingly sell more product to larger markets through the years? These are things that can be tracked. These are metrics that are concrete and available for people on public companies. It's one of the reasons why they have quarterly releases, so you can actually see if a company is holding up to what they say they're going to do. When a reputation is savage, this really impacts the value of a company. You could say a company's only value is their word, and a reputation is the word. Just like when you were in high school or when you're at work, the things you do and say impact your reputation with people, impact how much they trust you. To be able to buy into a company, you have to trust that they're going to do what they say they're going to do. There are also factors outside the company's control that have a big influence of the value of the company. The 4 that we'll be going over today are the industry or sector that the company exists in, the economy of the country that the company is in, the country's national environment, laws the government's going over, things like that, and the international environment, global events, things that are influencing everyone around the world. The industry a company exists in, or the sector a company exists in, will impact the value of the company. If AI is booming, a company that has AI products or has a sector of their products that use AI will probably be impacted positively by the boom of AI. If tech is having a lot of layoffs, then a tech company might also see some negative impacts on their stock price because the confidence of the tech industry as a whole for investors has decreased. So even if that tech company isn't having any problems with paying their staff and keeping people hired, because the industry as a whole is decreasing, then that means that less people are buying the tech stocks. The next 2 points are kind of similar, which is the economy of the country that the company exists in and the country itself. If we differentiate those points quickly, the economy is the sum of all of the markets that exist in that country. And you could also argue globally, but for this example, we'll talk about that country. So how the economy is functioning right now is going to have an impact on the stock price, because the economy tells us how much money there is versus how much debt there is. It tells you how much people want to spend money versus save money. How all markets are running is going to impact how likely someone is to buy one stock or one fund at one particular time. So the economy has a big impact, even though it's completely outside of the company's control. I actually took a lot of the inspiration for this video from Ray Dalio's How the Economy Works. I think that video is like 15 years old now, but I consider it a foundational video if you're interested in how money works and investing and everything finance. So it's one of the resources that I've linked below. Do check it out. It does take about half an hour, but I promise you it's worth it. I've showed my young kids it and they even understood. So definitely check that one out too. If we think more about the country that a company operates in or the national events of that country, that's a little bit less about the buying and selling of that country and more about the culture of the country and how that's impacting everyone's want to buy things. They're slightly different. So for example, when we saw the tariffs come in the US, that probably had an impact on stock prices because, and you can see that in some of the financial reports read recently, there's been additions to lines about how much tariffs companies like Apple will have to pay. When you introduce a tariff, that increases the cost of companies acquiring things from overseas and the cost of companies selling things to overseas. When you increase that cost, the profit margins go down. That means less money to pay people and less money to invest back into the product. And that influences the company's value. So when you have local laws that impact how a company is run in a country, that impacts the value of a company. Lastly, we have global events. So everything that's happening in the world at the time. It's funny to think that, if you have a boutique car producing company, like maybe you do an electric vehicle production company that just exists in a small area of the US, that something that happens on the complete other side of the world can have a big impact on you and your business. But that's exactly how it goes. So, for example, when Russia declared war on Ukraine, there was a huge impact on oil prices. The price of crude oil soared because Russia supplies 10 to 12% of the world's crude oil. So that's quite a large portion of the whole amount of oil that exists in the world, or at least in the market. So any company that had anything to do with oil, from cars to, anything that you can think of that uses oil, was impacted like that. It's one of the base commodities, so that has a huge impact on how the rest of the market functions. All of that is to say is that there's so many events outside of a company's control that impact its value and in turn impact your share portfolio. A company doing everything right could still be victim to a falling share price because of some external factor. That means you could do your research entirely correctly. You could predict a company's growth and trajectory right. Everything that you think will happen. And then something completely uncontrollable happens and that'll impact the share price. It's important to take this into consideration when we are investing, because you don't want to overextend yourself. That is, invest more than you can afford to lose. Because if something happens that you're not expecting, that we're not expecting, that the world isn't expecting, you want to make sure that you're not overextended and that you can still cover the costs that you need to live and thrive. That links in really nicely with the next thing I wanted to say, which is your financial journey, where you're at right now and how that's going to impact the money moves that you can make. There are two kind of strategies I think of implementing here, depending on where you're at in your life. Investing as a hobby and investing as a lifestyle. Assuming you've got your monthly expenses covered, that you have paid off all your debt and you're starting retirement planning, you can probably afford to invest seriously. If you're not up to that point yet, and to be honest, I wasn't up to that point for a long time, then you need to think more about investing as a hobby. Investing big bucks into the stock market regularly is not going to get you out of being broke if that's where you are. That's a whole different hurdle that you need to attack before you start seriously thinking about investing, which is why if you've got that itch, investing as a hobby is a better place to start. I used to think that you should only do serious investing if you're at a place where you can afford it, and not at all before that. There's a lot of other financial people who would tell you the same. I know Dave Ramsey would tell you not to invest until you're at a specific place in your financial journey. I didn't find that it worked that way for me. I found investing gave me a lot of motivation to sort out other financial problems I had, to maybe pay debt on time, or to get my credit score up to a number that I was happy with, or to put enough into my savings so that I felt like I had a good safety net there, and then I could focus on my investing more. It was kind of like that kind of shining star in the distance that I was starting to work my way towards with investing as a hobby. And so maybe that's the place you're in too, and that might be something that would work for you as well. Here's an example. If you were just starting to get fit, then you're probably not going to go and buy a $3,000 gym membership and buy a whole new wardrobe and invest a whole lot of money into getting fit. You need to like build the muscle of going to the gym all the time and getting used to being in kind of a more fitness mindset. It's kind of similar when we think of how we're going to invest. If we've never invested before, just suddenly putting thousands of dollars into the stock market, especially if there are other financial obligations that we have, probably isn't the best place to start. But just like in our fitness example, going to a fitness class is probably okay. Going to one a week is probably okay, and probably does help you build those muscles that you need to be able to go to the gym regularly. After a time of going to classes, then investing in an expensive long-term gym membership might be a good choice for you. Similarly, if you're just starting to invest, it might be a good idea to dabble. Just $20 here, $30 there, looking into the stocks and funds that you're interested in, researching them a little bit, and then just popping a little bit of cash into them rather than a lot means that you can learn a little bit about the stock market without having to take a huge financial risk. On the other hand, if you don't have big debts, maybe you just have your house or you've paid off pretty much everything and all of your month-to-month expenses are pretty much covered, you have enough for your bills and you've started saving for retirement, then it might be time to think about investing a little bit more seriously. I'm going to do a whole video on the different splits that you can do with your money, so stay tuned for that. I'll link it below this video when I do release it, so you can just jump straight to it. There are a few different strategies that you might want to take and why you might want to take them, but that's definitely a good place to start, especially if you're not sure how much of your money you should be allocating to each of those different kind of sections. I also want to touch on debt. We have been talking about it here and there during this section, but let's really dive into what it is and why it might be keeping you from reaching your financial goals. Debt is one of those things where at the time you're taking it out, you're like, yay, I get to afford this thing that I couldn't have afforded otherwise, or I get to go somewhere I couldn't have gone otherwise. But the thing about debt is it's just purchasing your current lifestyle from your future self. The better thing to do is always make sure that how you're living is within your means or a little bit below your means. I do want to let you in on the secret of why debt is so big, which is that banks make more money from you going into debt with them than they do from the stock market. Debt beats the market for them almost every time. Think of it from a maths point of view. A lot of good portfolios, good index funds, they will make you, 6, 8, 12% year over year on growth. But your credit card, your personal loan, these loans, they are 18%. 20%, 24%, 30%. So just based on interest alone, banks are going to make more money on debt than they are on the stock market. You are their income, so it's in their favor for you to be indebted to them. That's why debt is marketed to you so heavily. Paying off debt will actually allow you to enjoy the money that you have without having to constantly pay interest. If you're investing at the same time as having debt, you're going to constantly have to think, okay, what is the investment that I'm making versus the interest that I'm paying, and can it measure up? If it can't, then you're losing money investing rather than paying off debt to interest every month. So paying off debt first can allow you to kind of enjoy the fruits of your labor by investing without having to worry about, is the interest more in my investment or more in my debt every month? That brings us to risk tolerance. Risk tolerance is how much you can stand losing your money. If you've ever played a game of cards with friends and it starts off as like a few cents that you're all betting against each other, and then it gets up to $10, $20, $50, and you're like, whoa, I think that's just too much money. I don't want to put that on the table. That probably means that your risk tolerance is lower than the people who you're playing with, because they're willing to lose that much money to potentially win where you're not willing to. When you invest, there'll be varying risk based on what you're investing into. When you're thinking about your investment strategy, you have to think about how much you're risking losing. it's always good to think about a diversified portfolio when we're going into investing for the first time, especially if you're not sure about how much risk you want to take. Investing in something that's low risk and putting more money into a low risk investment like bonds or an index fund is probably a better place to start than investing in a new stock that's just one single stock that you really believe in and you think will go up, because then all of the money that you put into investing is dependent on that one stock doing well. If you don't diversify your cash, you're kind of betting on what you're investing into rather than looking at the market as a whole and having a little bit of exposure or a little bit of a stake in a bunch of different markets, meaning that if one market goes down or if one stock goes down, that doesn't matter because your portfolio isn't just on one stock, it's spread through a bunch of different places. By now you're probably thinking, wow, that was quite a lot of information and I feel kind of overwhelmed and I actually have no idea what to do. Okay, stay with me. Let's talk about a good place to start. One of the best things you can do is start reading regular news about the stock market, about the economy, about your country, where everything is right now. Having a good base knowledge about the market is going to make you so much more knowledgeable when you're thinking about a specific company or a specific fund that you want to invest in. If you don't know anything about the mining sector, that's going to make it difficult for you to decide if you should invest in a company that has some exposure to mining. Even tech companies have some exposure to mining because they use minerals in the products that they're producing. A good place to start would be subscribing to a newsletter that talks about the economy or the stock market, reading daily or weekly news updates on what's happening with the market right now to give you a good understanding, and just staying connected to global events can be a really big factor when you're thinking about how you should spend your money. Another good thing to do would be to make a watch list of the companies or stocks you want to invest in. If you are thinking about investing in a company, it's a good idea to watch them for a while before you do. If you don't know anything about a company and then you just start to buy into them, you probably haven't done enough research to put your money into it. This is a little bit more for if you're thinking about buying into a specific stock rather than a fund, but it still holds true for funds because you want to know what the split is in their investments, you want to know what their exposure is, you want to read a few of their press releases, and having a watch list and kind of creating a virtual investment list in your head and on that watch list before you buy into it can give you a good sense of where you're at in your research journey, if you're making good decisions or not, before you actually put any money on the table. Lastly, I'd also recommend doing maybe an investing game where you invest fake cash into real companies and then you can figure out if your investing is actually up to scratch, if you're going to make or lose money over a given period of time, before you actually invest anything into that. The thing about doing it this way is it's really kind of short term. Like a lot of the time when you're investing, you're not thinking about, okay, I'm going to buy and sell in 1 month. You're trying to think years into advance what's happening long term for this company, or at least medium term in the next 2 to 5 years. And playing the investing game is probably not something you want to invest 2 to 5 years of your time into. It can be a fun thing because you actually can feel like what it's like to win and lose without putting money into it. You can see, oh wow, if I had bought that stock, I'd be down 5%. And even though I'm not actually down 5%, I'm feeling something about that. So it's a good exposure that you can get to the stock market without actually risking anything. A more serious step you could take is looking into the investment accounts that you could open. If you're new to investing, you probably don't have an investing account yet, and you'll need one before you can start buying and selling. It used to be that you had to buy and sell through a brokerage where you had to put, $20,000 up to start, but now you can start with a lot lower funds and have a lot less kind of commitment to investing. This is a more serious step because you have to get into the nitty-gritty of what account might be good for you. Definitely start looking into the top investing accounts in your country and what might work based on your situation. Your bank probably has an investing account you could use, but you want to check to make sure the fees that they take are competitive so that you'll actually make money from the trades that you make. There are also popular online exchanges within each country. I know Wealthsimple is popular in Canada, and eToro in Australia, and Robinhood in the US. Check what would work for your country and for you personally. You want to make sure that they're not taking too much fees so you can actually make money, and that the platform is beginner friendly and not too hard to understand. If you have a lot of funds sitting around and you're like, oh my goodness, like I don't know if I'm ready to take the plunge yet, but I do want to do a little bit more research and do it in the future, definitely make sure your funds are sitting in a high interest savings account for the time being. It would suck if they're just in a regular checking account and you're losing money every month while you're making a decision. So make sure the funds that you're thinking of investing are popped somewhere safe that accrues interest over the time that you're researching what to put them into. Congratulations if you've made it this far. You're on your way to having a well-researched, diversified portfolio that's actually going to make you money. So good job! If you've liked the things we've talked about today, I'm going to have more videos coming up with pretty much all of the points that we've discussed in today's video and more. So subscribe if this is something you're interested in, and let me know in the comments if there's anything that you think I've left out. Don't miss all of the information that I've popped in the description. I have a very well structured sheet that'll help you learn a good basis of knowledge before you start. None of the links in there are sponsored or even affiliate links. They're just things that I think will be useful to you. So don't miss out, and see you next time. Bye.